Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Joining in to discuss all of this with us on the show this week is Nilesh Shah, Managing Director at Kotak Mahindra Asset Management Company. Nilesh, thank you so much for being with us on the show today. So, my first question to you is going to be on the macros and not the micros, because I think that's the puzzle everybody's trying to get their head around. Should we be worried about this rupee and current account deficit, oil prices, or should we take heart from the fact that the inflation print has been benign? What we got in terms of the August trade numbers, they were looking okay. IIP numbers seem pretty decent as well. Is there any reason to fear and worry about a big correction because of macros?
So it's $1 million question, and clearly today we have bottom-up situation which is looking far better. We saw Nifty results for June 2018 quarter, excluding Tata Motors and SBI. The earning growth is almost 20% and top line growth is 24%. If we look at 3,814 companies which have declared results, the top line growth is about 17%, earnings growth is about 25%. So there is a broad momentum bottom up visible in the corporate India, at least the listed corporate India. And again, on the top-down side, inflation at 3.69% is below RBI's, target level. Rupee has depreciated by more than 13% year to date. But if we look at on a 5-year basis, it's still one of the strongest currency. Vis-a-vis trade-related, it is still overvalued on a real effective exchange rate. From a current account deficit point of view, yes, if it exceeds 3%, it is into amber zone, but it is not red zone like it was in 2013. And the capital flows have been relatively strong. So clearly it's a kind of a situation where there are factors like inflation, fiscal deficit, which gives you confidence in terms of things are getting stable in India. At the same time, there are factors like oil prices reflected into current account deficit, which gives little bit of, sleepless nights to investors. And you also used the word escape velocity while we were, I was listening to you. In fact, it's quite strange that today US and India are two equity markets which are trading above its 200-day moving average, whereas most of the other markets like Japan, UK, Germany, Australia, China, they are all trading below their 200-day moving average. This is one of the WhatsApp forward which I have received just now. So it clearly shows that we are trying to escape from the falling emerging market and developed market equity markets to be one of those unique markets in the world like US, which is trading near its all-time high level. And maybe markets are telling that we should not be worried too much with the macro scenario. We should more focused on micro scenario. Maybe market is telling us that.
Nilesh, makes sense. So you put it all together pretty well. So, for now, immediate in the very near term, would you say the market is, this episode of correction is behind us? We saw about a 4% correction. That is done and dusted with, and we sort of look ahead with the firmer and with some confidence?
No, Prashant, I wouldn't say that, because clearly there are factors which are influencing market, and unless until those variable changes in our favor, it will be difficult to say that markets have made the bottom and there will be no correction. The first factor which we are looking at in the near term is oil prices and its corresponding impact on current account deficit, inflation and fiscal deficit. If oil prices goes towards $60, then I'm reasonably confident that markets have made a bottom. If it's going to go and cross $80 a barrel, then certainly that statement will not be valid. The second thing corresponding to that is US interest rates. Clearly, there has been fairly strong amount of recovery in US economy with GDP growth coming at 4% and unemployment at all-time low level. We have also started seeing average hourly wage rate inching up, and which is generally taken negatively by Fed. So if US interest rate starts moving further up than what is priced by the market, then it will be unfair to say that Indian markets have made a bottom and there won't be any correction. The third factor will be tariff war. Clearly, we have insignificant impact from the tariff war. The US and Chinese economy has far more significant impact. But still, as a collateral, we could have some damage from the tariff war unless until we actively go and protect ourselves. So how tariff war shapes up, how Trump levies those $200 billion goods tariff will have an impact on Indian economy and Indian market. And even if we come over the volatility caused by oil, US interest rates and tariff war, then eventually we'll have to face the political situation in May 2019. Market today is pricing in stable government, pro-reform, pro-growth government. As long as that kind of government is received, then hopefully market has kind of made a bottom. But if we don't get that kind of government and we end up getting a khichdi sarkar with no focus on growth or reform, then certainly markets haven't made a bottom.
You mentioned interest rates, Nilesh. That brings me to this one pocket of the market, NBFCs. Now that the cost of money, the 10-year yield, it did touch 8.2%. Are there any specific type of NBFCs that perhaps will get very vulnerable? So therefore, there may be margin compression and maybe some sort of a derating. Is it time to sort of make any changes to the NBFC part of someone's portfolio?
Definitely, one has to now become cautious on NBFC sector unless until they have a good liability franchise, a diversified liability pool, and at the same time they have exercised enough precaution on building a set book. Clearly, money is becoming tighter. 11 out of 21 PSU banks are under PCA. 6 are going towards PCA, so effectively 17 PSU bank are not lending money as freely as they were lending before. Second, the cost of credit is inching up. Money market rates have started moving up. And we have started seeing rating agencies become aggressive on the short-term rating side. And there could be some rating correction in view of what is happening in the money market. So availability of credit as well as cost of credit is going to inch up. And it invariably will have an impact on your asset side as well. So NBFC sector, it's time to be cautious and it's worth going back to the basics. Invest in those NBFCs which have very good liability franchise.
Very good liability franchise. Nilesh, for our viewers, can you identify stocks or pockets where there is significant valuation comfort? Good quality businesses where there is valuation comfort from here.
Prashant, clearly this is a growth market and we haven't corrected as much that valuation comfort starts emerging. Investors will have to pay for the growth. There are some PSUs where value is there, but whether those values will be unlocked or not is a question mark.
Oil PSUs?
And bearing those pockets of PSUs, oil PSUs included and some of the metal PSUs, there is value there, but those values needs to be unlocked. Similarly, there are exporters where courtesy the currency movement, their business model will receive some amount of boost and there could be some comfort. I wouldn't call it value, but at least I will call it as a little bit of cheapness vis-a-vis broad market. But more importantly, if you can invest in companies where in your anticipation the expected profit growth will be higher than what is priced by the market, I think that will be the new definition of value. That's where you will get your margin of safety. This is a broad growth market. You'll have to pay the right price and you have to invest in those companies where expected growth rate will be higher than what is priced by the market.
In a way, you're saying that you'll have to overpay, but if you can overpay less, that's the trick, right, Nilesh?
Yes.
Okay.
Yes, that's a nice way to put it.
Surabhi.
Speaking of overpaying or underpaying or smartly buying, this argument finally actually hit home on the FMCG and consumer basket, Nilesh. And it was a little, it was a little perplexing for me because there's nothing new. We've known that these stocks are extremely high priced. We know the multiples have been 50, 60, 70 times. So I'm not quite sure what triggered the 10% sort of fall in an HUL. How would you view this basket, and is this fall really the time to buy? Or is this, finally some sort of a valuation topping out of India consumer?
I think there is some amount of temporary cap on the India consumer from a valuation point of view. Today, if we see many of those companies, they are trading above their historical valuation, and their stock market return has been way ahead of their profitability growth. Now, over a period of time, the profitability growth and the stock market return will start converging, and hence it will be fair to say that the consumer-related stocks, especially some of those expensive consumer-related stocks, have probably reached their top in terms of valuation. And unless until we see a dramatic drop in Indian interest rate, which is not visible right now, these valuations will remain as a cap.
Okay, Nilesh, it's a pleasure. Thanks very much for joining us here on this edition of Taking Stock.